this episode of The Art of Boring, I sit down with Stu Morrow to go over what happened in Q2. Markets were hit by geopolitical shocks, diverging central bank signals, and a rally that looked strong on the surface, but was driven by a very narrow set of themes underneath. We unpack what happened across Canadian markets and in the global context, and more importantly, the implications for investors' portfolios. And if you're not already subscribed, please make sure to check us out on YouTube or wherever you listen to your podcasts. The end of another quarter, certainly a lot of volatility. Nice to see you, Stu. Looking forward to the conversation.
Yeah, me too. Lots going on. Lots to talk about.
So why don't we start with Canada? We saw a decline for 2 straight quarters in growth. So technically a recession, maybe not a true recession, but nevertheless, the way it's sort of defined it, we did technically trip the recession wire. TSX, I should say, did quite well, but did lag global peers. Commodity producers sold off a bit. So why don't we sort of start with what's going on in Canada, if you could sort of walk us through what happened in the quarter.
Yeah, sure. So it was, the definition of a technical recession. So in the first quarter, GDP contracted for the second straight quarter, did rebound in the April numbers with about 0.5% month-over-month growth, which was kind of on the stronger end of the last 9 months. You had seen 14 out of 20 industries expand. So, kind of by quarter end, a little bit after that, the recession label was, a little bit backward looking. If you dig underneath the surface as well, the headline GDP, if you looked at it on a per capita basis, so adjusting for some deflation in population, GDP actually grew on a per capita basis 0.9%. So it shows there's still some underlying demand there that's intact and may have met the technical definition of the recession, but doesn't exactly look or feel like a typical one. So maybe closer to stall speed economy rather than a contraction. And on the TSX itself, like in the quarter, in Canadian dollar terms, returned about 7%. So I'd say like a fair absolute return for just a 3-month period, but that certainly paled in comparison to some of the global equity markets, which were certainly powered ahead by the AI theme, which we'll talk about. And TSX didn't have a lot of that exposure, has more exposure to on the material side, which, as you said, gold and mining stocks did go back a bit. Price of bullion came back from its high in the prior quarter. So, back to your question, how stocks can rally while the economy looks like it's stumbling. We actually wrote a paper on that last September. It was titled Deciphering the Disconnect Between Markets and the Economy. It's on our website. And we explained how markets can be forward-looking, usually price in that recovery or downturn before it shows up in the macro headlines. So, where some of the data like GDP itself, like we're talking about, is backward-looking. Then there's also one other thing I'd say is the makeup of a stock market index could look different than the composition of the industries that contribute to GDP in an economy. So in Canada's instance, right, on the TSX side, on the index side, as you know, we're pretty heavy on the financials and energy, which dominate the index. And then in the real economy, it's, real estate and healthcare. Those are pretty meaningful parts of GDP, but they barely register on the TSX. So often when there's a disconnect, it's sometimes a reflection of just what the index does and doesn't capture.
Right. Yeah, that's a good point I hadn't really thought about that on the real estate side. I guess a lot of private investment. On the healthcare side, a lot of government spending, which contributes to GDP, but isn't going to be reflected in the stock market. I mean, it is good to hear, at least, that we had some GDP per capita growth that, from what I recall, had been on a pretty poor downtrend for quite a while. So it's nice to see at least there was a little bit of an uptick there. Although, to your point, I guess it was probably more a function of the number of people as opposed to growth. But
for sure,
at least it was moving in the right direction.
And some of those numbers too, right? Like they're within like some margin of error, right? That technical definition of a recession are down 0.1%. It's within that margin of error, so it may not be. So, keep an eye on that going forward for sure. I was going to say to you, like I woke up this morning, I thought, we'd start with this one, but I was driving to work and I, noticed the price of gasoline kind of change right before my eyes. And it really prompted me to turn on CNBC and turn off the music that I had. And lo and behold, of course, it seems like the war is kind of back on. We've seen the price of crude kind of back up a little bit higher this morning, at least at the time of recording, thoughts on how this has kind of, been playing out. Like obviously we have probably gained some insights into how to think about positioning for geopolitical risks in the last 6 months. But there's a lot going on. I don't know what kind of your thoughts are on the latest developments.
Yeah, I mean, I would have said up until this morning, there's kind of been two phases of what we've seen in terms of the geopolitical issues in the Middle East between Iran and the U.S. Um, as you kind of alluded to today, there's arguably been already three phases, and I'm sure maybe by the end of this conversation we'll already be in a fourth phase. So maybe I'll just give a little bit of sort of the summary of what's happened over the last few months, and then we can kind of get into what's changed. I would say the sort of first big phase, of course, was the shock, right? Like the initial outbreak of war, kind of late February, spilled over. So that certainly impacted markets in Q1, but it really did spill over into April. As far as it relates to commodity prices, oil in particular, you had a spike to, I think it peaked around $120 a barrel. So very big move there. Obviously, the Strait of Hormuz, this bottleneck for global energy, a bunch of other commodities too, but certainly energy being probably the most important. Basically, effectively, the strait being shut down. And so that sort of fed into inflation expectations, right? At the end of the day, commodity or energy itself, the price of the commodity is highly impactful for inflation, but it's also feedstock for other goods and services that are being, well, more so goods that are being produced. And so as a result, the market really, to your point earlier about it, looking ahead and trying to factor things in, expectations, the market really moved pretty quickly to a more hawkish expectation on interest rates. So in other words, expectation for greater volume and faster interest rate hikes by central banks. Certainly in Canada's case, that's a tough position for the bank to be in because as I think we've talked about in the last few quarters and certainly the conversation you had about technical recession, things are weaker here, but yeah, you've got inflation. So that I think we talked a lot in the last quarter about stagflation as a risk and that this is kind of a potential realization of that risk. So that was kind of the first phase, and then second phase was really the reversal, right? So you've got towards the end of the quarter, odds of a peace agreement were starting to improve. This memorandum of understanding between the U.S. and Iran to sort of have this 60-day ceasefire, which obviously as of this morning is potentially in question now with some of the statements that President Trump has made, and I think a re-engagement on the military side. But nonetheless, that at the time in June was seen as pretty constructive for the markets. Oil really sold off, going from, again, that $120 a barrel basically to around $70. I think it's moving around a lot today. I think we're at kind of 75, maybe a little bit higher than that. So it has moved off the lows, but still quite a bit lower than the peak. And so you had a big unwinding of that inflation fear. Gold, to your point as well, gave back some of those gains. Again, it tends to be an asset that when there's a lot of inflation concerns, gold's usually seen as a safe haven. I guess for us, the sort of big takeaways, and this one's actually almost dated in some ways, but in some ways it's also sort of been reinforced, is really that the risk has not disappeared. It's eased, but it's certainly this conflict is not done. Even when it does hopefully come to some conclusion, there's always the risk of re-engagement, whether it's here or another area of the world. And so, that I think is the first takeaway. And again, we're seeing that this morning. The second one is really, I think, a good reinforcement of some of the benefits of having commodity exposure in portfolios. I know we're sort of sometimes seen as being less inclined to invest in commodities. And I think that's a fair assessment from clients and others in the industry. But we certainly do have some exposure. And maybe the nuance that sometimes people miss is that there are periods where we have a lot of exposure and even more than the benchmarks. And this is certainly over the last, I would say, couple of years, we've sort of ticked up, I would say, our exposure both on the energy and the mining side in most of our portfolios. And I think that the role that it plays, whether you think about certainly geopolitics, but even inflation concerns, fiscal strains, that global fragmentation that we're seeing, not just in the last few quarters, but really over the last number of years, that's all still holds. So obviously we need to make sure that we're looking at stocks from a bottom-up perspective, but when you're doing that bottom-up work, these sort of macro themes do ultimately feed into commodity producers when you're doing your assessments of them. So that really, I think, was reinforced. And then the last one is really geopolitical risk is looking increasingly like a baseline condition that investors have to consider. I certainly would have said, and maybe you would have said as well, that these are sort of tail events that we're seeing right now. But when you keep seeing them happen, quarter after quarter, year after year, then obviously it's not necessarily all that much of a tail position anymore. So we are certainly, again, not getting into the forecast of trying to call the outcomes of these things, when exactly they'll start or end, or what the situation will be. I don't think we have any special edge there, but certainly we need to factor in that this is more of a potential reality, and there's a wide range of outcomes. So when we're constructing portfolios, it's important to make sure that we have some exposure on the commodity side. Again, assuming the valuation works and the quality of the business, quality of the management team has to be there. But there's certainly some portfolio construction benefits, I think, of commodity exposure.
It's not easy, right? Like the de-escalation, escalation seems to be, like you said, it could be different by the time we finish recording this. And like for central banks, it must be even more difficult, to drive changes in, levels of interest rates or changes in expectations of interest rates or guide markets too. So you mentioned Bank of Canada, like there's been other central banks moving on interest rates, some of those, potentially diverging from what the Fed is doing or not. I don't know what your perspective is on that in Bank of Canada, but maybe some background on, what other central banks have been doing kind of at these crossroads.
Yeah, I think it's definitely been a quarter of divergence as far as central bank activity. To your point, some have, I think they've been moving in different directions, certainly. In Europe, the ECB did raise rates in response to some of these inflation concerns. They're a bit more sensitive to energy prices, given that a lot of the energy inputs that they use come from the Middle East and other regions. They're not necessarily large producers, kind of across Europe generally. Bank of Japan also continued normalizing rates in the quarter, as they have been for the last little while, which is a pretty big shift from the decades sort of preceding the last few years. Domestic conditions have continued to support higher rates, so basically a return of some level of inflation and decent growth. And then in the U.S., though, they stood pat. The bigger news there was less around rate movements and more the new Fed chair, Kevin Minas. His initial message was arguably a bit more hawkish in tone, more of a focus on fighting inflation, making sure it's not persistent, less reliance on forward guidance. But at the same time, I think that's probably understandable that's, he would come out hard out of the gates. There's a perception of potentially some sort of political overtones to the appointment. Would he be soft on rates because that's what President Trump wants? So you could sort of understand why he'd come in a little bit heavier on the hawkish side, notwithstanding sort of what's going on. But I do think the current circumstances kind of warrant that approach that he's using right now. So I think that's fair game. But yeah, ultimately the Fed didn't move, and then similarly, Bank of Canada didn't move either. There were two meetings, April and June. They had cut rates quite a bit already at this point, so they're already relatively supportive in terms of monetary policy. And as I was kind of alluding to earlier, you have on the one hand these inflation concerns or fears that we saw kind of earlier in the quarter, offset against this softening economy. And so that's really a tough spot to be in if you're a central bank. In terms of, I guess, how we were positioned or how we were thinking about all this, certainly in our Canadian bond strategy, I should say, ultimately we were concerned naturally that higher energy prices would feed into inflation, all else equal. That would force the Bank of Canada off the sidelines. At the same time, though, the more energy prices were going up, and if they stay up for a sustained period of time, which obviously they haven't now, but if they had stayed relatively high, that has a bit of a knock-on effect or a disinflationary force potentially if it's enough inflation to actually slow down growth, because you ultimately crowd out other spending. You can only cut your energy consumption so much, so you only have a certain amount of dollars. At the end of the day, if you're spending more on energy, maybe you have to spend less elsewhere, and so that can have a disinflationary impact. The governments are kind of around the world stepped in and did have some sort of relief or policies basically to give some relief to consumers. In Canada, we saw that in the form of a relief in terms of the gas taxes. And so ultimately, we thought that was, a reasonable response. There were, with that bout of inflation, you saw yields kind of moving all over the place. As yields sort of sold off, in other words, yields went higher, we sort of tactically added some duration to the portfolios. And then as the yields kind of came back in, when markets thought, okay, the inflation fears have kind of gone away, again, we took off that duration position. So, a good example of where, there are opportunities to sort of tactically trade around some of these things, especially on the fixed income side. As rates are the more volatility you get in the rate space, the more you can kind of make some of those adjustments in the portfolio.
A new Fed chair, like I took away from some of that, at least the first press conference, there are a lot of task forces. So many tasks to do. It's kind of interesting. But there's also like this underlying tone of changing the communication style or itself. It's the tone of the Fed to the market. Like, is the bond market figuring that out, or have they figured it out? Or
I think it's pretty early still to say that there's a good read on it. Like, that's certainly, I think, the message that was delivered. But I think it's pretty early to say, as I was kind of alluding to earlier, like, it's how much of this is sort of just job owning, or you want to kind of set a precedent now, especially with all the sort of political undertones that have been sort of focused on the Fed and the previous chairman. That's kind of my read. Frankly, I think we need more evidence before we can have more conclusive say at this point. So we've spent quite a bit of time on the sort of fixed income and macro side of things. Why don't we talk a little bit more about the equity land? I feel like we'd be remiss having a podcast over the last couple of years without talking about AI and the CapEx. And so I feel like we should probably cover that now. Certainly in the quarter, we saw a lot of announcements about, again, continuations of that CapEx spend, the hyperscalers, memory stocks, of course, doing very well, emerging markets putting up their best quarter in the last 15 plus years. So kind of what's your read on what's happened there? What's the team thinking around this AI build out? Are we getting to the point where there's maybe concerns around overcapacity? And then EM specifically, what's been going on there, particularly given the level of exposure to semiconductors?
Yeah, I know. So like the extraordinary period of where we've gone through this capital light period in the economy to now more capital intensive, right? And the numbers that are kind of thrown out there is you take a look at like Amazon, Alphabet, Meta, Microsoft, and Oracle. It's $750 billion plus this year, up from $400 billion or so last year, headed towards $900 billion in 2027. So extraordinary numbers. And a real shift from what was asset light to capital intensive. And I don't know if you can draw a line today, or anyone can, between what's, this going to be a transformative build out or overcapacity. I'd be skeptical if anyone says they could, but the CapEx is real. We know this. The earnings behind it are real, being funded by cash generative businesses, not just leverage and kind of hope, which is different than past cycles. At the same time, there's this widening gap between some of the performance of those names along the stack. So those who are spending on the AI build out and those who are capturing the revenue side of the build out. So I guess there is a risk of overcapacity. At the same time, there's a risk that this could be very early days and this still has a lot more to go, or call it a cycle or super cycle. That's kind of the framing that we've used on the last kind of Art of Boring podcast with Paul, which was you can't just eliminate those risks. You can choose which ones you're going to tolerate. And the memory specifically is memory stocks is one example, right? Where you think about what's priced in or what the price to earnings ratio is today. It's the risk isn't necessarily in the price, the P. It's rather the cyclicality of the E. In other words, it's the earnings themselves might not be as durable as the current pricing models assume. And I guess that's the real risk or question mark, right? Not really what multiple you're paying it if it's cheap or expensive today. So, really, I think for us trying not to call a top or a bottom or get into that debate, but, continue to measure that overall net AI exposure in portfolios. So we're not levered to one side of that potential outcome. And practically that's meant over the quarter trimming names, right? Like the headline memory names, which have run pretty far, pretty fast, ahead of what, and some other businesses trimming those or exiting those businesses where we think, the valuation has kind of gone beyond, or the current prices beyond the current valuation, staying invested in those where we, still see value. And I think it all goes back to, yes, there's been some real kind of short-term winners and perceived losers. But for us, given the portfolio, given the volatility in the market, I think it's, this tension, that exists between being concentrated and overexposed and being diversified. Those two things are quite different right now, right? And we're in this market where we're being driven by this narrow set of AI-linked kind of winners, where it's semiconductors and memories stocks, like you said, in the last quarter or last 6 months, versus this diversified portfolio going against a benchmark or an index, right? I don't think it means diversification is wrong. I think, there's a trade-off there. The concentration does help relative returns in a rally like this, and diversification helps resilience maybe when those names pause or reverse. And maybe we've seen a little bit of that in the short term in the last few days in the first part of the third quarter. But you can't get both, right? Which is, I think, is why we stress, in risk management can look disappointing in the short term, right? In a quarter like this, perhaps just on a relative basis, trimming names, rebalancing, all of those, the right decisions that you do, holding names outside of the hot theme, right? That aren't, on the field, but they're on the bench as substitutes. All of that can feel like it's costing you the short run, but it's really valuable over the cycle, which is important for investors to keep in mind. And it's not us ignoring what's changing in markets. It's really, building portfolios that can survive multiple outcomes. We've talked about a lot of things, right? Like AI enthusiasm, just now, geopolitics, inflation, rate changes, Fed change. It's a lot of uncertainty. So I think that, all kind of portfolio construction and process matter quite a bit right now. So one of the things leading off of that, talking about hyperscalers, names around the technology stack, they've of course been, borrowing to build out this infrastructure build out that they're going through. Some of that has come through on the debt side, not just we've seen also on the equity side, but also on the debt side. So, thoughts from you on the quarter, the second quarter, any sort of things that stood out in credit markets, how spreads have behaved, how is this supply being absorbed, kind of thoughts on that from you.
Yeah, sure. I would say overall, it was a constructive quarter for the credit markets. Returns were generally pretty solid. Spreads stayed quite contained, at least from the beginning to the end of the quarter. There was obviously some volatility in between, given the geopolitical issues we talked about earlier. But sort of beginning versus end, spreads were quite tame. You got your coupon. It was pretty healthy backdrop overall. But yeah, to your point about hyperscalers, we did see that was certainly noteworthy in the Canadian market. We saw both Amazon and Google come to the Canadian investment grade bond market for some pretty sizable issuances, actually record breaking, particularly in the case of Amazon, where they did a $14 billion 5 tranche deal. Both deals were well subscribed or oversubscribed, which means there was a lot bigger order book than there was available debt that was being issued. In the case of the Amazon deal, investors got close to full fills, meaning there was only just slightly more of an order book than there was supply. Partly, that's not totally surprising, just given the size of the deal, but it also came after the Alphabet deal, which was so. Perhaps that's sort of indicating that, there isn't boundless appetite for new credit, especially given the size of the deals. But they were both quite attractive. We participated in both. The spreads were decent, I think, considering the quality of the businesses. They were, kind of single A high and double A credits. So again, there's not a ton of that exposure in Canada, particularly not in IT. So you're thinking about, okay, you get decent spread. You've got a lot of a high quality business with a lot of relatively strong or very strong balance sheets. Yes, there's a lot of CapEx being spent and the revenues aren't necessarily all there yet. So that would obviously be the main counterpoint, but certainly very good businesses with lots of liquidity. So we thought that the deals were still quite attractive ways to diversify the portfolio. That was really the big, I would say, sort of theme in the quarter for credit markets. That was certainly newsworthy. But ultimately, the credit continues to chug along. The spreads do remain very tight. I know we've been talking about that now for literally
A
years
long
at this
time.
point, but it remains true. So investors aren't necessarily getting a ton of compensation for going sort of out the risk curve. We participated in relatively shorter dated positions, and to the extent we have a small overweight in credit in our Canadian bond strategy, and then of course a global credit, which it is predominantly credit, we tend to be in higher quality, shorter dated securities. We continue to have that positioning just because you're not getting paid to take on incremental risk, but the all-in yields are still relatively attractive in the shorter end of the curve. And so that's kind of where we're at today. It's a nice way to, I think we've kind of covered equity, we've covered fixed income, we've covered the macro. I think a nice thing to always end with is, what we did on the asset allocation side within the quarter. Lots of turbulence in the markets, as we've talked about already. Given some of those concerns and volatility, and perhaps there was opportunity as well, what did we do on the asset allocation side in the quarter?
Yeah, so briefly, like a few deliberate shifts that stood out in the quarter in the balance strategy. We talked about equity markets ran pretty hard, trimmed back some of that strength into fixed income to bring portfolios back to where their intended asset mix should be, rather than letting that equity strength kind of passively drift higher. Kept a preference in that for international equities and emerging market equities over the US, given still more reasonable relative valuations, and where our US equity fund is actually positioned with lower weight towards the most concentrated AI leaders at this point. It actually, acts as a partial hedge, right? If that group of stocks, does start to lose momentum or steam kind of going forward, right? So, and then within each strategy, as we've kind of, sort of talked about a little bit here, is, we've been actively trimming positions that had run, pretty hard very fast, and those that are ahead of our valuation bands, and then, taking that capital and recycling back into those names that have, better risk reward. So overall, positioning bound strategies back towards more of a neutral stance in the quarter.
Awesome. So, yeah, more of the sort of maybe somewhat boring approach to asset allocation, where you kind of, trim your winners, redeploy it, keep your risks relatively balanced. But yeah, I think it's a prudent approach over the long term. I think that's a good point to leave off on. Nice talking to you again, Stu, and looking forward to the conversation next quarter.
Yep. Thanks again.